Navigating the nexus of transfer pricing and ESG. Importance of ESG in transfer pricing. ESG, environment, social and governance factors are increasingly influencing corporate strategies and operation, including transfer pricing practices. The alignment of transfer pricing with ESG principle is crucial for ensuring that business practices not only comply with tax and transfer pricing regulations, but also contribute to sustainable and ethical objectives. Certain considerations. Adapting to ESG-driven business changes. In the face of substantial transformations driven by ESG policies, transfer pricing teams are finding themselves at a crossroads. They must proactively decipher ESG-related shifts, understand the implication of business transformations, anticipate their impact on result, and align their transfer pricing policies accordingly. For example, any alteration to supply chain, distribution channel, etc. necessitate a thorough examination, including the allocation of transformation costs and the subsequent impact on associated enterprises within the multinational group. Operational and business model transformations. M&Es delving into ESG integration must meticulously evaluate the tax impact of operational and business model transformations. This encompasses changes to supply chains, reorganizations, and the integration of ESG objectives. Alignment with value chain and value creation. This involves ensuring that transfer pricing arrangements reflect the economic reality and contribution of different entities within a multinational group, considering their roles in achieving ESG objectives. ESG consideration influence profit allocation, supply chain decision, and overall transfer pricing model. Companies must navigate the complexities of modifying transfer pricing models, functional analyses, and the methodologies to incorporate ESG considerations effectively. Global tax landscape and regulatory developments. The global tax landscape is continually evolving with increasing emphasis on transparency and fair taxation. Staying informed about the regulatory developments and proactively adjusting strategies is essential for maintaining compliance and also for leveraging tax incentives for ESG-related activities. Entities within an M&E benefiting from ESG-related or public subsidies or incentives must assess the associated risk. This involves understanding which entity is the beneficiary and the strategic implication of such subsidies or incentives. Transfer pricing documentation considerations. Robust documentation and reporting are vital for demonstrating alignment with ESG principle in transfer pricing. Companies must ensure that their transfer pricing documentation reflect ESG-related reorganization or other changes comprehensively. For example, the master file should provide an overview of ESG impact on business operation and transfer pricing policies. Local documentation should reflect changes in transfer pricing result influenced by ESG initiatives. Fostering collaboration and effective communication. Successful integration of transfer pricing and ESG requires collaboration between different functions within a business. It requires a coordinated effort between tax, sustainability, and other teams, and a deep understanding of how ESG factors impact the value chain and profit allocation. Transparent communication with stakeholders about ESG-aligned transfer pricing practices is also crucial for building trust and credibility. A proactive management of transfer pricing obligations. Companies embracing ESG initiatives must meticulously assess the potential impact of their transfer pricing positions. Implementing robust transfer pricing policies coupled with diligent collection and maintenance of accurate data and documentation becomes paramount. Such measures empower organizations to adaptively manage the intricate interplay between transfer pricing and ESG initiatives. Developing risk management strategies. Integrating transfer pricing and ESG involves navigating various risks, including regulatory, reputational, and organizational and operational risks. Companies must develop robust risk management strategies to identify, assess, and mitigate these risks. This involves continuous monitoring, regular reporting to stakeholders, and effective collaboration across tax, legal, sustainability, or other teams. Businesses should proactively monitor and adapt their transfer pricing strategies to ensure compliance with ESG goal while navigating potential challenges in the evolving landscape. Conclusion: successful implementation requires a comprehensive approach that considers ESG principles, economic substance, and value creation. Collaboration, robust documentation, and a proactive stance towards evolving global tax regulations are essential for achieving alignment and managing associated risk. As companies develop a shared understanding of the value of ESG in business practices, they can prevent disputes and ensure that their transfer pricing policies aligns with their overall ESG strategy. Navigating the